Ladies and gentlemen, Greg McCloskey from ForexLive.com. Today's date is March 10, 2023. This is a morning Forex tactical report where I take a look at the technicals that are driving the currency markets. But today we also had some fundamental news with the U.S. non-farm payroll coming out at 311,000. They're expecting 205,000. The prior month was revised from its elevated level of 517,000, but only to 504,000. So strong jobs growth, but the unemployment rate did move higher to 3.6% from 3.4%, and the average hourly earnings increased by 0.2%. That was a little less than the 0.3% expected. So on the surface, it was a stronger jobs gains once again, but we are seeing some little chinks in the armor. What is probably more important is what is happening in the banking sector. The Silicon Valley Bank situation seems to be contagioning or having the markets very concerned about the contagion in the financial arena, and that is leading to sharply lower yields. The two-year yield is now down nearly 18 basis points at 4.725%. Remember, it got up to 5.09%, I think, at its highs this week. So that's down 28 plus 9, 37 basis points just in the last few days. The 10-year yield is trading down minus 12.6 basis points at 3.79% currently. It was up above the 4% earlier this week. So seeing the yields move sharply to the downside on a flight to safety on concerns of banks, and that may lead to the Fed not doing the 50 basis points. Despite the 311,000, certainly the debate is on. Once again, we'll see what the CPI data comes out next week, and we'll see how this Silicon Valley Bank and other potential banking issues play out. But the calculus as far as the Fed is changing as we speak, and so we are seeing the U.S. dollar actually move a little bit lower here. Well, it's a kind of mix. It's moving lower. Overall, the euro versus US dollar is higher. This pound versus US dollar is lower, and the dollar yen is dollar Swiss, dollar Canada. Let's get into the technicals. We'll start with the euro versus US dollar. This is the hourly chart of the euro versus US dollar, and you can see the market moved above the 200-hour moving average. That 200-hour moving average stalled the rally earlier today. Lots of ups and downs, price action, but the market or the data came out, and we are seeing the euro versus US dollar move to the upside, breaking above the 200-hour moving average, also above the 50% retracement of the move down from this week's high to this week's low. That level comes in at 1.06086, and as you can see, the current price is trading around 30 pips higher than that at 106.35. Actually less than 30, so it's still in play on the downside. The price should rotate back lower. We could see a retest of this area, but the bias certainly is more to the upside. We also moved back above this trend line. This trend line was started back here, and we also it started here and here. We tried to hold it right here and moved above it. Then use it as a base right here, moving higher, and then we tried to hold it right here once again, and then fell below it and used it as a resistance right here. So even though the market moved above this level right here, which we use the line as both a support and a resistance level. So pay attention to this level right here. This level comes in around the 106.20 level on a corrective move to the downside. Maybe we could see look for support against that level in the euro versus US dollar. But overall, we're seeing a little bit of more dollar weakness despite the 311,000 in job gains for the month for the non-farm payroll. So that's a bit positive. So watch 106.20 level, watch the 106.08 level. If we move back below each of those levels, that would dampen the bullish, short-term bullish bias here in this currency pair. Let's take a look at the dollar versus yen next, and on the hourly chart, we saw the price move below the cluster of moving averages that starts with the 100-hour moving average. That's the blue line right here. Then we get below the 200-hour moving average. That's a green line right here, and we've also moved below the 100-day moving average. That's nothing new. Earlier today, we were below all those moving averages, and yesterday we moved below them as well, and earlier this week we moved below them as well. So, but what we want to see is the price remain below those moving averages. The 100-day moving average comes in at 136.15. That is the closest one. If the market can stay below that level, the bias will remain to the downside. We look toward the 61.8% retracement of this move from this low to this high right here. Then we look toward this swing area right here, which I think is probably the more important level to stay above. As we go back in time, we can see the number of different times that it was a ceiling. We moved a little bit above it here, but then fell back below it and then tried to use it as resistance and then use it as support before moving to the upside. In trading last week, it came down toward that level. In trading this week, earlier this week, we came down within about 10 or 12 pips of that level and also found support buyers. So getting below the 61.8% and getting below this level right here would be key for the dollar versus yen to increase the bearish bias, open the door for the downside. If we can't get below those levels, if we start to move back above the 100-day moving average, 200-hour moving average, 100-hour moving average, all bets are off to the downside. We will see how that plays out. But right now, we're staying below the 100-day moving average, keeping the sellers more in control in dollar versus yen. Let's take a look at the sterling versus US dollar, and you can see this pair moved up and it is testing a nice key resistance target. That target comes against this trend line connecting this high to this high. We moved right up to the level, and we are finding some willing sellers against that level. Also, right near this level is the high ceiling that we had right through here near the 120.49 level. And the price did move above it earlier this week, only to fail quickly against that level. And you can barely see it, but we did reestablish the resistance against that level right through here. And here are all the different highs that we had against that level. So needless to say, this trend line and also the 120.50 level, I'm going to call it that, is the key levels to get to and through. If we get above those levels and then get above the high price that we saw earlier in the week of 120.64, that would open the door for further upside for the sterling versus US dollar. On the downside, we'll be watching the 100-day moving average earlier today. This is the hourly chart, but this line right here represents the overlay of the 100-day moving average. It held resistance against that level, moved down to test the 200-hour moving average, and then rotated to the upside, breaking above the 100-day moving average. So needless to say, the 120.08 is the key support in the sterling versus US dollar. Stay above it is more bullish. That's the 100-day moving average. Finally, let's take a look at the dollar versus Canada. We saw Canadian jobs increase a little bit higher than expectations. We saw the unemployment rate tick up a little bit. Overall, we know that the Bank of Canada kept rates unchanged this week. So there is a bias to the downside in the Canadian dollar, but we are watching the dollar Canada move to the downside following the dollar's move overall, and I sort of expected that. On the downside, however, we'll be watching the key 100-hour moving average and 38.2% retracement. That level comes in converged at 137.425. If the price comes down to that level, we would look for support buyers to try to hold support against it. The level also corresponds with lows right here before the market moved to the upside through here. So 137.425 is a key level on the downside for the dollar versus Canada. Keep that level in mind going forward. My name is Greg McCloskey. Good fortune with your trading. Bye-bye now.